This is part 2 of a 3-part video on purchasing a home. In this video, I'm going to dive into the cost of home ownership and give you a framework to evaluate how much you can afford. Hey everyone, this is Michael Tortorich and thanks for tuning in. Just a quick note in the video before we get started. These videos are designed to complement my book, Running the Numbers, a step-by-step guide to life's major financial decisions. Each video corresponds to a chapter or section in the book, and the idea is to review these chapters and use the videos as a platform to add some additional color around the examples where it just wouldn't have been practical to do in the book. So to check out the book or additional videos, please visit my website at michaeltortorichfinance.com, and there is also a link to the website and the book in the description below. So in part 1 of this video, I explained what a mortgage is and showed you how to calculate the payments for some of the common types of home loans. And in this video, I want to look past the payments and delve into all the other costs associated with a house. So, as I mentioned at the beginning of part 1, the cost of owning a home is not limited to just your promissory note. In other words, your monthly loan payments. You're also going to have property taxes, insurance, maintenance, homeowners association fees, and side projects. And what I want to do next is look at an example of these costs, and I'm going to show you how to quantify each one so you can build a more comprehensive picture of the true cost of home ownership. So let's jump into an example. So let's assume you're going to buy a house for $400,000. You're going to put 20% down, have a 3% interest rate, and it's a 30-year amortizing fixed rate loan. Now, the first thing you need to do is calculate the loan payment. And if you noticed, the assumptions that I've just laid out are the exact same ones that we used in the previous amortizing loan example from part 1 of this video. And we know from that example that the loan payment is $1,349 a month. So, because we've calculated this already in part 1, I'm not going to go into the math again, but if you need a refresher or if you just want to reference back to the calculations, please see the link above to the Chapter 8 Part 1 video. Now, the next thing you need to do is factor in the property taxes, and property taxes are typically paid to the local government every year and calculated based on the appraised value of your home. Now, just as a side note, there's a great deal of variability in property tax rates. So depending on the state, the county, the city, school districts, etc. that you live in, these rates can vary widely. But for this example, we're going to assume the property tax rate is 2.5% and the appraised value is the same as the purchase price of your home. And the formula and calculations for property taxes are pretty straightforward. You're simply going to multiply the house value times the property tax rate. So in this case, it's $400,000 times 2.5%, which is $10,000 a year or $833 a month. Next, you need to factor in property insurance. And just like property taxes, insurance can vary greatly depending on where you live. So if you live in a flood zone or an area that's earthquake prone, you're likely to pay higher prices versus if you live somewhere where natural disasters just aren't a problem. And just in case you're asking yourself, do I really have to get property insurance? I mean, what if I live somewhere where natural disasters just aren't a problem? Well, as part of the conditions of your loan, the bank is going to require you to maintain insurance on the home until it's paid off. And in this example, as we're assuming you're taking out a home loan, you're going to need to buy property insurance. And there's no calculations to be done here. To find out how much property insurance is going to cost, what you need to do is call either an insurance broker or reach out directly to an insurance company to get different quotes. And then you can make the decision based on the best pricing and coverage options available. And for this example, we're going to assume that this cost is $100 per month. Now, just as a quick aside regarding insurance on your house, if you put down less than 20%, the lender is also going to require you to purchase private mortgage insurance, and you'll commonly hear this referred to as PMI insurance. And this insurance protects the lender from losses in case, for whatever reason, you default on your loan. Now again, this is only required if you put down less than 20%. And as soon as you've paid down at least 20% of the principal, you can cancel this insurance and eliminate the extra expense. expense. And in this example, because we're assuming a 20% down payment, I'm not factoring this in, but it is something you want to factor in if you plan to put down less than 20%. The next cost is home maintenance, and this cost is unavoidable, and it's going to be a combination of planned and unplanned maintenance. And some examples of planned maintenance are things like weekly and seasonal yard maintenance, yearly AC servicing, interior and exterior painting, things like that. Some examples of unplanned maintenance are garbage disposal replacement, plumbing leaks, or roof issues, broken sprinklers, the list goes on. Now, you're not going to know the exact timing or cost of these, but you can be 100% certain that you will incur them. And it's really prudent to save for these costs so you're not caught off guard. And so in this example, we're going to assume that you're either spending or saving $200 a month for maintenance costs. Next are homeowners association fees, or HOA fees. So homeowners associations have historically acted as independent third parties to ensure that residents uphold basic neighborhood standards. And each home will pay a small monthly fee to the HOA, and the HOA is going to take action for any violations of neighborhood rules. So let's say, for example, if your neighbors let their front yard turn into a jungle or decide to paint their house pink, the HOA is going to fine them and try to enforce those neighborhood rules. And nowadays, most single-family homes, townhomes, condos, etc., have monthly HOA fees. And over the years, as neighborhood amenities have grown, a lot of communities now come with swimming pools, tennis courts, etc. as standard, so has the role and the fees of HOAs. And particularly for townhomes and condos, as they usually have a lot of shared amenities, the HOA functions more as a facilities management company and subsequently is going to charge higher fees. Now, HOA fees can vary widely depending on the type of home, the neighborhood, amenities, etc. But for this example, we're going to assume a $300 per month HOA fee. And I actually do want to talk a bit more about HOA fees, but just so we don't get too sidetracked in this example, I'm going to circle back to this topic at the end of the video. So please stick around, and what I'm going to do is show you a better way to think about these fees in the context of the overall purchase price of the home. So the last expense I want to talk about is side projects. Now, everyone wants to put their personal touch in a home, and this inevitably results in side projects. And these are things like installing new window shades, adding knobs to the kitchen cabinets, painting accent walls, new light fixtures, the list goes on. And these costs are going to be different for everyone, but one thing that's certain is that you will spend money on side projects. And so we're going to assume $200 a month for side projects. So now that we've gone through all the typical additional costs, let's take a look at a summary of all the estimated costs with owning a home. And so as you can see here, in addition to the monthly payment, after you take into account property taxes, insurance, maintenance, HOA fees, and side projects, the amount that you'll actually pay in this example is $2,982 a month. And this is more than double just the monthly payment of $1,349. So now that you have a better idea of how to calculate the true amount that you'll need to live in your house every month, the next question is, well, how much can you really afford? And a good sanity check to do when you're determining whether or not you can afford a home is to see how much you need to earn on a pre-tax basis to meet the monthly cost. And to do this, the formula and the calculations are as follows. You want to take the monthly cost and then divide it by 1 minus your tax rate. So if we assume your average tax rate is 15%, we would take the $2,982 and divide it by 1 minus 15% for a monthly cost of $3,509. So you need to make $3,509 per month pre-tax to have enough after-tax dollars left over to pay for your house. And if we look at it on a yearly basis, you'll need to make $42,105 per year to afford your home. Now, it's also important to note that this is just for the house itself. You'll still actually need to make considerably more than $42,105 because you're going to have to pay for food, utilities, transportation, and all the other expenses that just come with the normal living. And keep in mind, these are just estimates. Your actual cost for any of these items might be higher or lower, but the key takeaway is the framework that we've just reviewed to test your affordability. And this framework is also useful as a sanity check when getting a home loan. Now, theoretically, when you go to a bank for a loan, they're also going to do a similar analysis when determining how much they're willing to give you. But just because a bank approved you for a certain amount doesn't necessarily mean that you have to borrow that full amount. Ultimately, you are accountable for repaying the funds, and it's your responsibility to act as a final check to ensure that you don't take on too much debt. Now, we're almost at the end of the video, and thanks for sticking around. And as I mentioned earlier, I want to take another look at HOA fees and show you how I factor them in to my home purchase decision. So, HOA fees are paid in perpetuity, and that means that they're going to be paid as long as you own the home. And I like to think of HOA fees as a lifetime loan payment that I need to make. And the question I always ask myself is, how much would I have to invest today to generate enough passive income to pay for these HOA fees? And in the previous example, we assumed HOA fees are $300 a month. And let's also assume that a low-risk deposit at your local bank is going to pay you a 2.5% yearly return. And we can determine the present value of the HOA fees by calculating how much you're going to need to invest today to generate $300 a month at a 2.5% interest rate. And because the fees are paid in perpetuity, in other words, forever, we can use a perpetuity formula to calculate the present value of the investment needed. And this formula is really easy, and you can run the numbers using a basic calculator, and the calculation is as follows. You're going to take the yearly investment income needed and divide that by the interest rate. So you'll take $3,600, which is $300 a month, times 12, divided by the interest rate of 2.5%. Again, that's the rate of return that your bank is going to pay you for the funds invested. And that's going to give you a present value of the investment needed of $144,000. So to generate enough investment return to pay the HOA fees, you have to invest $144,000 today at your local bank. And this is the same as increasing the purchase price of the house by $144,000. So although a $300 a month HOA fee may seem reasonable, it's actually pretty expensive. So in summary, HOA fees aren't inherently bad, but you should be skeptical and pay close attention to what you're getting in return, because even a seemingly small monthly fee can add a significant cost to home ownership. And so that takes us to the end of Chapter 8, Part 2. And if you like the video, please don't forget to subscribe and hit the like button. And in Part 3 of this video, I'm going to show you how to compare a 15 versus a 30-year loan, and also give you a framework to evaluate if refinancing makes sense for you or not. And lastly, for more information on the book or additional videos, you can check out the links in the description below or my website at michaeltoldrichfinance.com. Thanks for watching.